Welcome to this explainer. Today, we are tearing into a genuinely brilliant analysis by financial analyst Chaudhary Zishan. We're looking under the hood of Ferrari's balance sheet between 2020 and 2026. And let me tell you, this isn't just a story about selling incredibly fast cars. It is an absolute masterclass in how a company completely re-engineered its financial DNA to become a true luxury powerhouse.
To get a grip on how they pulled this off, we'll quickly run through their overall metamorphosis, look at how they managed to double revenue and profits, break down their fortress of a balance sheet, dive into that exploding free cash flow, and finally answer the big question, are they even an automaker anymore?
So let's jump right into the Maranello metamorphosis. We're talking about their evolution from a niche ultra-luxury player to a high-margin juggernaut. Just trace this journey for a second. Think back to the 2020 pandemic dip. They were facing immense pressure, right? But notice the acceleration. Boom! By 2022, they capture this massive wave of luxury demand. By 2023, they launched the Pura Sangwe, their highly anticipated four-door model, and it instantly makes waves. Fast forward to 2026, and they are deep into preparations for a fully electric vehicle. It's a total business evolution in just a few short years.
And this right here is the crux of the whole thing. Because of their incredibly high margins and the fact that customer demand radically outpaces supply, investors don't compare Ferrari to Ford or Volkswagen anymore. No way. They're being measured against luxury titans like LVMH and Hermes. Why does that matter? Well, traditional auto is cyclical. You have to pump out volume to survive. But luxury, that's about brand equity, pricing power, and being essentially recession-proof. Ferrari intentionally crossed that divide.
Okay. Let's open up the income statement and look at exactly how they literally doubled their revenue and profits.
Check out these numbers from Q1 2020 to Q1 2026. The climb is just unstoppable. Back in early 2020, revenue was sitting around 932 million euros. Jump to the Q1 2026 guidance and you're looking at a staggering 1.848 billion euros. What's driving this crazy climb? Extensive customization. Buyers are literally throwing money at them to personalize these cars. Add in the Pura Sangwe, which brought SUV-scale growth without killing an ounce of their exclusivity, and the top line just explodes.
Just to put that into perspective, we are talking about a 98% growth in revenue over just a 6-year period. For a company that artificially restricts how many cars it builds so they stay exclusive, hitting a nearly 12% annual growth rate is just a wild feat of engineering, both mechanically and financially.
But hold on, because here is the real shocker. Net profit grew even faster, up an eye-watering 149%. Let that sink in. It proves they have the absolute power to hike up prices way faster than their costs are rising. They pushed that high-margin personalization and maintained absolute scarcity, and all of that drops straight down to the bottom line.
All right, so how does this look on the balance sheet? Let's dive into their luxury capital structure.
As you can see, their total assets basically doubled, growing roughly 95% from 6.1 billion euros in early 2020 to an estimated 12 billion by 2026. They didn't just hoard their cash, they aggressively expanded their manufacturing, ramped up R&D, and poured massive investments into electrification. But look at this. Shareholders' equity, which is basically the true net worth of the company, absolutely skyrocketed, going from 1.7 billion all the way to 4.1 billion euros. It actually outpaced asset growth. Whenever equity outpaces asset growth, it means a company is generating immense wealth internally, and that is a massive green flag for investors. So why the 140% explosion in equity? Simple. Massive margins and piling up retained earnings. They are converting profits into book value so much faster than a normal car company ever could. Honestly, it's a masterclass in disciplined capital allocation.
And honestly, this is my favorite part of their balance sheet. While the company literally doubled in size, their debt completely flat. It hovered right around that 2.5 to 3 billion euro mark. They actually finished Q1 2026 with a net industrial position of 388 million euros in pure cash. They have completely ditched the old, heavily leveraged automaker playbook.
Which leads us perfectly into the most mind-blowing part of this explainer, exploding free cash flow. Take a look at how effectively they turn revenue directly into cold, hard cash. Even with capital expenditures steadily rising, because, they have to build factories and develop new tech, their free cash flow isn't just creeping up, it is surging quarter after quarter.
The sheer magnitude here is literally staggering. We are talking about an 11 times increase.
going from just 57 million euros back in Q1 2020 to 653 million in Q1 2026. That is a compound annual growth rate of roughly 50%, generating that kind of cash while keeping production numbers tiny and heavily investing in EVs. It's incredible.
So how exactly are they pulling this off? 4 key moves. First, untouchable pricing power on their special series models. Second, the Purosangue SUV acting as a huge earnings multiplier. Third, a mountain of commercial and racing revenue from Formula One. And fourth, this is brilliant, exceptionally better working capital. What does that mean? It means customers are putting down massive cash deposits before the cars are even built. The buyers are basically funding the factory.
And all that extra cash gives them incredible freedom. They're boosting dividends, aggressively buying back shares, completely upgrading the Maranello factory, and fully funding their EV development. All without taking on massive debt. They are entirely self-funding their own future.
All right, let's pull all this together and ask the million-dollar question. Are they a car company or a luxury brand?
It really boils down to this. An industrial automaker absolutely survives on volume. They have to push millions of units to make the math work and survive. But Ferrari? They rely on intense scarcity, fat margins, and a massive cash cushion with practically zero inventory risk. It's the exact same capital structure as a luxury fashion house, just on wheels.
But as we look to the horizon, here's the ultimate stress test. Will their highly anticipated 2026 fully electric vehicle sustain this flawless trajectory, or will it break the spell? Can they keep that emotion, the scarcity, and the insane pricing power without the roar of a V12 engine? You better believe investors and enthusiasts alike are watching incredibly closely.
If you loved diving into Chaudhry Zishan's analysis and want to keep decoding massive business transformations like this one, hit that subscribe button right now. Thanks for hanging out with me for this deep dive into the numbers, and I will see you in the next explainer.